Hello and welcome to the CNBC-TV18's Mumbai newsroom. I'm Sonal Bhutra and with me is Ekta Batra. You're watching MF Corner. So today, Ekta, we are going to be speaking all about risk, which every investor should be wary of as well, right? When they are taking forward that mutual fund investing journey, understanding the risk, basically combating them will help investors navigate several market cycles as well. So lots to discuss because it's not only about returns all the time, a lot about risks as well.
Absolutely, Sonal. And we are seeing some amount of trepidation in the market. So a good time to even, in fact, get that risk assessment. On that note, let's welcome Prableen Bajpai, who's the founder at Finfix Research and Analytics, to discuss in detail the risks. Prableen, hi, welcome to the show. Well, let's kick it off by you telling us how important is assessing risks while investing in mutual funds. Can you name the risks, and then we will drill down and discuss them in greater detail.
Hi, Sonal, and good afternoon, Ekta. Great to be on the show today. And absolutely rightly said, risk and return, I think, are the two sides of the same coin. And depending on the market conditions, I think investors usually tend to focus on only one. In better times, it is the returns which are in focus, and usually the risk factors are ignored by investors. And in times when markets are, witnessing a downfall or there is little stress on the streets, it's usually the risk actually which is, highlighted. And, focus on only one of them actually results in taking decisions which are not optimal for creation of any portfolio, because the complete understanding of not only the return expectations, but the risk which needs to be taken to get those returns is important. And in finance, we often say that, higher the risk, higher the return, of course, which comes with the caveat that it's not in direct proportion and does not necessarily apply, because the higher returns are never a guarantee. So probably a better way of saying it is that when we are looking at lesser risk products, we are looking at a lesser return potential from the product. And as the risk goes higher for a specific product, a scheme, or an asset class, the potential for return, and of course, both sides, is higher in terms of higher returns, as well as, the loss component also can be higher. So for a retail investor, in a nutshell, it becomes very important to understand what sort of a risk he or she is taking when a portfolio is being created. Because as individuals, we have our own comfort with a certain level of risk. So the compatibility of an investor's return profile, his or her risk appetite, in line with the portfolio risk is, it's the core to portfolio building. And when it comes to mutual funds, there are a number of risks, right, starting with market risk to credit risk to liquidity risk, fund selection risk, concentration risk. And I think, we'll be talking about them in detail.
Oh, yes, because there are a number of them that we need to address as well, right, Prableen? But the biggest and the basic one, because a lot of them directly like to invest in equity mutual funds, and that's the go-to category for a lot of investors. What is about market risk? How big of an issue is that? How does one work around this while building an MF portfolio?
Right, Sonal. And I think the importance of market risk can actually be understood because no mutual fund advertisement is, without a disclaimer which says that mutual fund investments are subject to market risk. So it is a risk which is called the systematic risk. Market risk is equal to the systematic risk, which is further equal to the risk which cannot be diversified. So adding more and more mutual fund schemes or adding more stocks to your portfolio cannot, reduce the market risk in your portfolio. That's number one. Secondly, it's influenced by several factors. That means these factors are the ones which, when happen, impact the overall market, be it large caps, small caps, a technology fund, or a banking fund. It is not restricted to a specific sector, a market cap. It affects the overall market. And these factors are usually inflation, geopolitical conflict, instability, political instability, drastic changes in interest rates, which we saw last year, how the US markets responded to the rising interest rates and the inflation. Along with that, we have natural disasters. So, these are the risks which are not really in control. And also that to quite an extent, they cannot be actually managed at a portfolio level, Sonal. So, yeah, little ways where I think one can reduce the market risk. It cannot be completely negated. There are a few ways. The first thing here to understand is that market risk, we say that any mutual fund portfolio, we give it a value which is called beta. It is a statistical measure of measuring the volatility. So when a portfolio is constructed, if you're looking at a mutual fund scheme and if you just analyze its beta, it can tell you what is the relation with the market. So market's beta is always considered as 1. So if I am going and investing in a mutual fund portfolio, let's say a flexi-cap fund where the beta is 0.8, for example, it means that if the market goes up by 10%, the fund will only go up by 8%. But vice versa also, because if the market tanks by 10%, my fund will also fall by 8%. That's how theoretically it works. And a lot of funds are also able to, move it in the same way, the way the beta values are. Of course, with little differences here and there, it's not as exact and accurate as the math comes out to be. For example, a flexi-cap fund like Parag Parikh has a beta of 0.64, while a HDFC flexi-cap fund has a beta of 1.044. So this one just tells us, how different portfolios are created. And when we are creating a portfolio, we can probably look at schemes where the beta values are slightly lesser. And this is more for a person who's really looking to restrict the downside, because the investor needs to understand when you're having a portfolio beta of less than 1 overall, the return potential is also restricted. And I think the other two things which can be done is that investing for the right time horizon, because that helps negate the market risk, and then following the right asset allocation, only allocating that amount of money into equities and equity mutual funds, which can be kept for the long term and where the risk can actually be taken.
Okay, all right. Very comprehensive answer there, Prableen. But in addition to the standard risks which are associated with mutual funds, there is the fund selection risk, which is a newer one. What exactly is that, and what does the risk comprise of?
Actually, yeah, this is a new one. Also, I think it has come into more focus since the time we are having more of passive funds come out in the market. So broadly, we have two strategies. One is the active funds and one is the passive funds. So passive funds, as we all know, simply replicate the index. So the risk of any passive fund is equivalent to whatever the risk of that index is, or equivalent to the risk of the market broadly. Now, when it comes to active funds, we have a fund manager who is constituting a portfolio for us, through their research. And the objective of that investment is to be able to beat the markets. But what we are seeing is that in different
looks like there is some sort of technical issue. We'll connect back to Prableen as well. But as she's been mentioning, there are a number of risks that one should be aware of while investing in mutual funds as well. It's just not the market risk, Ekta, which mutual funds also keep indicating. There's liquidity risk, there's credit risk. She recently spoke about the new selection risk, because there's so many categories available, and 54 fund houses. Amongst that, there will be some 10-15 schemes, so much to choose from.
Absolutely, and the competition is only growing. The kind of demat accounts which have opened, the SIP monthly inflow gives you an indication in terms of the kind of interest that we're seeing in the whole mutual fund space. But Prableen, we lost you there for just a minute. If you could just complete your answer there.
Yeah, sorry. So basically, within the active space, we are seeing that there are a certain number of funds which are not able to beat the benchmark, and that creates a different kind of risk, because how do you select the right fund which is able to beat the benchmark? And as per the SPIVA report, we saw that in the large cap space, 93 to 96% of the funds couldn't outperform the index, and I think that is very high on a 3 and 5 year basis. 10-year basis, it reduces to 67%. And for the small and the mid-cap space, it is still very high at 50%. So this is one part of risk, that you're selecting the right fund which is able to beat the index. And there's another risk that within the active strategies, even if they are able to beat the index, there is a huge divergence in the returns. the best and the worst performers. And because of that, I think investors, usually get trapped in recency bias and tend to chase the best performing schemes, which creates another kind of a risk, which is all, we just put it under the fund selection risk bucket, where, you're looking for the right fund, but only you have to have the right information and the right knowledge to be able to pick the fund which can actually beat the index, which not many of us actually know how to do, and it is very difficult to do because we don't know how the future performance will be.
Oh yes, that's a risk everyone takes as well. But the other category which has been very hot, but there have been a lot of ups and downs here, and that's the international funds. There's a lot of attraction there, but there is a risk that these funds carry as well. Which are they, and what should be done in order to protect investors from that?
So actually, Sonal, when it comes to international investing, it actually takes us away from one kind of a risk, which is, the country-specific risk. Because if all my money, let's say, is in India, maybe if there is a fall in the markets, my job is in India, all your, real estate, everything is in India. So having a proportion of your assets outside the country can actually give you the benefit of diversification and reduce the country-specific risk as well. This would be especially, applicable to, let's say, investors in countries like China, where the markets have been, seeing very flattish returns, or, more of a downfall than the upward markets. So some allocation to the US, let's say, for them would be beneficial. So while it brings some benefit and reduces country-specific risk, at the same time, now it exposes us to two different risks. The number one is the exchange rate risk. So let's look at the S&P returns for 2017. So Sonal, during 2017, S&P 500 gave us 21% returns, which is quite good in the US markets. But that year, for Indian investors, the return only turned out to be 13.89%. That is because the rupee had appreciated against the US dollar by that 6-7%. The difference is because of the rupee appreciation. So our returns in rupee terms were lesser. But if we look at 2022, the S&P 500 fell by about 18.5%. But for an Indian investor, if I had invested and at the end of the year, my returns were actually only down by 9.5%, because the rupee had depreciated. So somewhere the exchange rate risk can also work in your favor. But if you look at the longer term, let's say last 10 years, somebody invested in 2012, 13, for them, rupee has depreciated by more than 65% since then. So, they would be at an advantage. But for investors looking to now invest outside, if you invest today and if rupee starts to appreciate, it will reduce your returns. But if rupee depreciates further, it will enhance your returns. So this matrix is broadly simple, but because we invest in tranches and over a period of time, the relationship is not that direct as I'm explaining. But broadly, if it appreciates, we are at a loss. If it depreciates, we are at a benefit. The second risk here is the regulatory risk, and it has two parts, Sonal. The number one is that we don't know how regulations in the other country would be. There can be changes which can be hampering to our investments. And second is also the regulatory risk at home. For example, last year, the limit for investing outside for mutual funds wasn't increased. And during the whole year of 2022, when markets in the US were really beaten down, a lot of investors could not enhance or continue with their investments because regulators in India, the RBI, had not increased the limit of investing outside. So they will always to be able to contain the rupee depreciation. So when investing abroad, there will be these kind of risks which investors definitely have to understand.
Okay, all right, Prableen, we need to take a short break, but on the other side, we'll continue our discussion with Prableen on the risks involved in investing in mutual funds. Stay tuned. Welcome back. You're still tuned into MF Corner. Well, we still have with us Prableen Bajpai to discuss the detail of mutual fund risks. Well, Prableen, you know, one of the things that we wanted to know is what do you mean, or what does one mean when we say that a fund has liquidity risk, and which kind of funds in fact have this kind of risk attached? And in what circumstances will we see a fund which has higher credit risk, and which are the funds which are probably most prone to it?
Right. So broadly, it is the debt category of mutual funds where we see both the liquidity and credit risk. But liquidity risk can also be present in equity investing, especially when it comes to smaller companies and schemes which have exposure to the small cap and micro cap stocks. Because if it is a huge AUM, it can be difficult for the fund house to sell that block of stocks without really disturbing the equilibrium and the fair price for what they are expecting. But in simple words, liquidity risk is actually present almost in any asset class, and it is the inability to be able to convert that asset or that security into cash. And it is present in real estate. There are times when we want to sell a real estate product, property, but we are not able to do it, so it's called illiquid. And something similar can happen in mutual funds as well. Two cases here. The number one is because of the very structure of the mutual fund. So very structure of the mutual fund, for example, closed-ended funds are not available. I mean, they cannot be sold right after buying. They are only listed on the exchange, and you can go on the exchange and try and sell that. But usually the volumes at which it's traded and the number of buyers for that is lesser. So, getting the right price for it is difficult. Again, due to the very construct, you cannot exit an ELSS fund before 3 years. So investors have to be sure when they're entering a product that they understand that they cannot exit a specific scheme during that time period. And then comes the risk of liquidity due to investments which are held by the fund house, where maybe the securities which are held are of lower quality, or there is a bad news regarding that company, and the price of or those bonds or securities has gone down, or they are not able to sell it. So that's liquidity risk. And credit risk is broadly the risk where you lend your money to someone and the money doesn't come back. And if we look at, there is a specific category, actually, credit risk funds, where they are investing more than 65% in AA and lower rated instruments, and any bond has been given a credit rating. Higher the credit rating, higher the credibility of the company. Oh. And credit risk increases for any portfolio where the companies with lower rated securities are held. And investors have to take higher return.
Okay, all right. Looks like there's another technical issue there. So we'll try reconnecting with you, Prableen. But important to understand credit risks and liquidity risks as well. And more importantly, how do we combat those risks? So Prableen, tell us, you detailed about the different kind of risks one investor would face. How can one combat the risk associated with mutual fund investing? If you can quickly tell us that.
Yeah, so I think a couple of points. Number one is understanding your own risk profile and appetite, risk compatibility between the portfolio and your own risk appetite. Second, having clarity of the investment horizon, so that invest in the wrong product with the wrong horizon. That will make it a disastrous decision. Third is investing according to your financial goals. That gives clarity. If it's a long-term investment, you can have equity. If it's for the near term, you can have more of fixed income and debt. Maintaining your asset allocation is very important, and avoiding like the recency bias and confirmation. They can actually help in not only mutual fund investing, but investing generally in any kind of product.
Okay, all right, Prableen, we're going to leave it on that note. Pleasure speaking with you. Thank you very much for joining in and giving us an assessment in terms of the risks associated with mutual fund investment. as well.
Okay, so that is all about risk and we spoke about that as well. But you know, Ekta, you were briefly mentioning earlier as well how SIP numbers have been through the roof in the month of August. So we were just taking a look quickly because while markets have been quite flattish in last couple of days, or I would say they've been declining, the August numbers looked really phenomenal, and that'll come up for you on the screen as well in terms of flows, because that is something that we should be talking about in terms of investments into equity schemes. That's 20,161 crore rupees, and we are awaiting, of course, the data that will come in for the month of September very soon as well. If we talk about mid-cap funds, they did really well with flows of 1,791 crore rupees. But small cap flows, they have ebbed a little bit. So that is something that continues to be the big story, whether this outperformance in mid-cap and small caps will continue or not.
Yes, absolutely. And you know, the kind of interest that we've seen in terms of SIP funds. So for equity inflows itself, it was a 5-month high in the month of August. It came in over 20,000 odd crores. But look at the kind of SIP funds, the number of demat accounts that we have. For example, SIP inflows in the month of August stood at around 15,813 odd crores. So that is above 15,000 for the second consecutive month, or for the second month itself. So that's the kind of interest that we are seeing in our markets. Whether or not that's going to wane, whether or not there is a bit of a halt on that, we'll wait by for the September data. We'll get more data then.
Oh yes, it's expected in the first week of September, so we'll have that here, analyzing it for you as well. But for now, that's all we have on the show today. Stay tuned for Closing Bell to take you through the last hour of trade.